Hello, hello, everyone. This is Brandon Jones. Excited to be bringing another deep dive conversation to the network focused on acquisition entrepreneurship. This conversation is part three of a three-part series that we're putting together in partnership with Live Oak Bank. This is demystifying acquisition, valuation, and underwriting, which is clearly a great transition from our last conversation, which Mr. Kalen Weaver, who's joined us, helped lead, and he'll also be leading his third one as well. The one that he led before was streamlining the acquisition documents and getting a sense of the timeline and how to be efficient in that process. And then we previously had a conversation as well, which was capitalizing the A to Z guide for funding your acquisition. We had that conversation in December with Mike, who's also a leader on the team who we've been excited to partner with. Lillian is also on the line, and she has been a very useful resource for us, and we're really excited to have this partnership. So, with that said, I'm going to reintroduce Mr. Kalen Weaver, who's going to be helping us dive into acquisition fundamentals from the perspective of a loan officer. But before we get into that, Kalen, please reintroduce yourself and let us know why this is a conversation that's important to be having.
Awesome. Thanks, Brandon. Like you mentioned, I'm currently a loan officer, been in the SBA space, the SBA world now for a little over 6 years. So it's been great to dive deep into this world of acquisition and entrepreneurship and helping folks become more familiar with the acquisition space and what the process looks like, right? Like, that's the biggest question that most folks have in mind when they're thinking through their journey from um, entrepreneurship through acquisition and so on and so forth, right? So I get most excited about demystifying and making more clear the approach to the acquisition process and clearing up some of the underwriting processes and what you should be expecting. And so hopefully that's what we get accomplished today.
Excellent, excellent. So let me kind of like paint a little picture of, I spend a lot of time in the space with folks that are at various stages, right? Some folks are
Hmm.
very accomplished professionally and they're exploring it because they really want to, look at ownership as the next phase of their, evolution, building generational wealth, their legacy. And then you got folks that are, under LOI right now trying to get a deal done. One thing that I see a lot is, particularly from people that don't come from financial backgrounds, right? Whether
Hmm.
they're not an ex investment banker, they're not an ex PE folk. And we have a lot of those types of folks in our network. This is where they get intimidated even before they even start the process because they wonder, am I sophisticated enough in terms of financial engineering, to even execute on this right in a way that's going to deliver returns? And so, with that context, and then we have this funny because in our last conversation we talked about sometimes folks are over engineering a little bit, particularly if they're
Yep.
PE
Yep.
background, really sophisticated deals that may not necessarily resonate well with the seller. But let's speak right now for the folks that are, kind of coming in maybe from a P&L background, but haven't really negotiated deals, done any M&A in the past. At the end of the day, it comes down to some fundamentals, right? What, from your perspective, regardless of what someone's background is the recipe for someone approaching this phase of kind of the buy a business journey, which is how do you understand what the right value is for a business? And I'm just thinking from a philosophical perspective, and then we'll kind of get a little bit more into the details.
Yeah. Um, I mean, I like to tell folks all the time that, if you're focusing in on price and you're like, man, this business is overpriced or overvalued and so on and so forth, right? Like, some people don't have a general understanding of what like fair market value is, and we usually say like it's a willing buyer and a willing seller, right? So whatever a buyer is willing to pay for a business should be the foundation, the recipe that you're looking to put together, right? You should know how much you are qualified to put down on a business, how much you can afford, how much you're willing to pay for a business, so on and so forth, right? So understanding that is really crucial to that recipe. um so yeah, I think that's a important aspect there.
And another piece that comes into place is obviously we talked about this, in depth in our last conversation, which is the bank is very deep in the numbers, right? Because you want to make sure
Mhm.
you're protecting your side of that, of the deal, the risk. You want to make sure that everything is real. You're doing a good amount of diligence as well. But at the same time, people might not necessarily be clear on what the bank's role is when it comes to valuation itself. How would you uh, say the bank is positioned in this process of determining value for a business? So you have a potentially a willing seller or, a target that you think, is a high likelihood you can engage. What should be people, what should people be thinking about with Live Oak in terms of what, coming up with the right valuation for that business?
Yeah. Um, so yeah, I mean, I think first we should, set the expectation of what, valuation process is. I know a lot of folks have an understanding of that foundationally, but um, really for us, the valuation aspect is the expectation for sellers, buyers, lenders, on what the actual purchase price is, and what the value of the business actually comes down to be. Um, and so that actually is something that's determined outside of the walls of the bank, right? Like the bank isn't determining the value necessarily of the business for the buyer and seller. The bank is really playing the part of how much can this business support from a debt perspective if you're looking to take out a loan to purchase the business. So our goal and our role is to help determine what available cash flow is out there to support any debt obligation that this business can take on, and what are the key factors of maintaining that? Because I know we talked about in our last conversation that that's a caveat to go back and check that out. But um, disruptions to cash flow is the biggest thing that we look for when determining a good credit and healthy credit. So that plays a part into that value proposition, right? Like we have to understand what are potential disruptions to cash flow, and so that's a good plug for the to tune back into that last call that we did last week. So.
Yeah. Um, and I think that is really, important. I think the way these conversations have been sequenced are in the right order. Uh,
Mhm.
so, you really broke down the debt service coverage ratio, right? Which is something people need to get really familiar with if they're not. And also kind of what you're saying is, look, if you found a business and a seller who is willing, right, and a price that ultimately you're looking to see whether or not from a cash flow perspective, it can serve the debt at a certain ratio, and they can support that with documentation and there's nothing disruptive that you're saying, you're good. Any value that, the entrepreneur creates on top of that, meaning what can serve the debt and then what their
Mhm.
upside is great for the entrepreneur, but that's not necessarily where you're focused. You're not going to advise them on, you know, how to make, how to adjust the offer or how to potentially negotiate additional terms. You just want to know what is the price, what is the business doing, and can it service this debt with enough cushion? And also, and we talked about this in the last conversation to your point, what is your own situation financially as a buyer, to one, not only show that you've been prudent in your own financial situations, but also you don't have a lot of complexity or introducing things you haven't done before in the business, which I think is really important. Can you help us understand, like, of the parties, seller, buyer, bank, what is the role of each party in the valuation? And I guess particularly from the bank side, the underwriting process for these deals.
Yeah, that's a great question. So if we think about it from a process point, right? Like a seller identifies that they're looking to either retire, no longer can run the business, want to move on to, pursue other opportunities. They decide to sell a business. What does that typically look like? They're setting a value, right? They may engage a business broker that helps them set an appropriate valuation, right? And hopefully there's a lot of really key points that go into that, and um, some definitive like responses and reasons for why it's priced at where they want it to be priced. So the seller's role is to really, and the broker, are their job is to defend that value, right? They want to set up using documentation that they currently have of previous cash flow and other data points about the industry to help set the stage for this is the price I'm looking to get based on all these very varied factors. Um, then the buyer comes in and they want to review those financials. They want to bring those to the attention of any financing partners, any investors that they have on their side of the table. And they also want to just personally prove that they are qualified to run that business and manage the loan appropriately. Right. So then that's what is the part one of the process that we talked about in week one and week two. Who is our operator? That's that high level point, right? Of whether or not this is a good credit. Who is our operator? Who is our buyer? What is their experience? Have they managed people before? Do they have experience in the industry? Have they led a team through tumultuous times? Right. That's a pretty important question that we usually ask folks, because we want to know. Like we want to know: have you led people through a time where people have experienced loss? They maybe experience something personally that their employees are going through, and you have to manage through that. So, what does that look like for you if you're stepping from corporate into a small business world where those things become really crucial to the operation of the business? So the buyer's role, I just want to stick there for a minute, right? Because that's a really crucial point, selling point for you to sell yourself to the seller on why you should be the one to own this business, and to the bank on why we should lend to you in particular to buy that business. Right. So that's really important. Lastly, I'd say the bank, during our underwriting process, we are using that opportunity to conduct our own due diligence. We're verifying all key data points that the seller and buyer have provided. We're ensuring that the business can appraise at the value that we're hoping for, right? So that means that we order a third party business valuation, and our third party vendor will help us assess whether or not the business is priced at where it should be. And then our goal at the end of the day is, again, going back to it, is to make sure there's enough cash flow to cover debt service coverage ratio.
Excellent. And I want to pull the thread a little bit on some of the things you touched on because there's a lot in there. Let's start maybe with the last piece you talked about, which is the third party business appraiser. How often do you see situations where it'll get to that point and there's actually questioning or kind of a determination that that business isn't necessarily going to appraise for what was underwritten from the buyer's perspective? Like, can you maybe give a sense of like how often you see that situation come, play out?
Yeah, I mean, in our world, it certainly happens more often than not. Um, But I would say, I mean, typically it's usually we can identify it through cash flow, right? So cash flow is a really good, and debt service coverage is a really good indicator on that valuation process. Because if you've got a business that's just very barely making cash flow, and there's not a lot that's included in the purchase, right? And when I say included in a purchase, we like to talk a lot about, um, if you're buying goodwill, what all is included in that goodwill? Are you buying payables? Are you buying receivables? Is there inventory involved? What does that look like? Right. So that plays into value as well. So we are really on the front end focused in on that debt service coverage, making sure that it adequately meets what the bank needs to see. And typically, when that happens, that's where we like to say is pretty much a strong indicator on where it might come in at, as a value indicator. So hopefully
Yeah,
that
that's
helps.
helpful. It was basically, look, cash flow, cash flow, cash flow. That's where you all are
Mhm.
focused. By the time you get
Yeah,
to
yeah, yeah.
the finish line, those boxes should have been checked. The other piece that you kind of, the dynamic that you kind of introduced is let's call it a cast. The primary characters are the bank, the buyer, the seller, but then you have other supporting cast members. So the third party appraiser, you probably have potentially a quality of earnings that the buyer might bring in to do some diligence on that front. You might have, a lawyer. Um, in the ideal world, that you operate in, what is the amount of interaction between those other ancillary folks, not engaged by you, like the business appraiser, in the process? Do you want to do, directly engage only with the seller? Do you invite kind of these interactions with other players involved? Does it complicate things sometimes? I'm just kind of curious, from your perspective, how that all plays out, orchestrating all these kind of cast of characters together.
Yeah, good question. I would say usually the bank follows the lead of our buyer. Understand this is a partnership, right? Like we want to partner with our buyer, and um, really, I mean, I heard it put this way before, but sometimes we serve as a consultant in a way where we're stepping in and we're saying, here's where we feel like, um, this process, we see this process going. it might be beneficial for us to engage in a conversation with the bank, talking to the seller directly to better understand this. But we'll take your lead, right? So we'll take the buyer's lead and understanding that we don't want to obviously jeopardize any relationship the buyer has with a seller, with a broker, with any of their, you mentioned ancillary cast members that are part of this transaction. But just know that the bank wants to be a resource and we should be used as such. So use us the way you would like to and just let us follow your guidance in that. So,
Yeah. And it sounds like, we talked a lot about this in our last conversation, but ultimately engaging early with the bank helps drive clarity around just the different styles. Who are the folks that are going to be involved, and just kind of getting on the same page and get an alignment. So it's not a zoo once, kind of
right,
uh,
right.
the race starts, so to speak. Okay. So let's talk about, how economic factors influence the borrowing power. And obviously, borrowing power is a really, really important piece of it. I know you look at personal, I know you look at the business, but ultimately, what type of business can an individual expect to target is one of the biggest questions that people have coming into it. So, how should folks be thinking about this specific aspect of, buying a business?
Yeah, I think borrowing power plays a key role into the valuation discussions, right? Because you may have a business that is appropriately valued based on the cash flow and where it's currently at, but um, maybe we can't leverage the business as much as we want because of economic factors that are outside of the deal's control, right? So, um, what's what comes to mind most for most people actually is interest rates, right? So um, interest rates play a huge role into, how much debt can be leveraged against a business. And as we all know, the Wall Street Journal Prime is usually what we price our business loans at, and that's been since 2020 has increased severely. We're starting to see a little bit of a dip as the Fed is cooling on interest rate, holding the interest rate where it currently is. But I like to say that obviously interest rates play a crucial role into your buying power and what you're going to be able to leverage against the business. And actually, think this is the appropriate opportunity to show sort of a graph demonstration because I think visuals help when we think about how to best describe this. And so I'll start with this chart here, but as you can see, and just as a caveat, these dates on here, I know we're in 2025 now, so they're a little dated, but really just a representation. I think this is just a great illustration of an example on what we could say like borrowing power looks like and the change over time based on interest rate increases. So if we look at this chart, right, we started at the very top, March 16th, 2020. The prime rate was at three and a quarter. Right. If we kept a lender spread, which we usually tell folks to in their graphs, in their projections, aim for um, prime plus 2%. Right. So if we're looking at prime plus 2% on a EBITDA, a business that has EBITDA of around $1 million, we're saying that the buyer's salary is going to be roughly around 150,000. We're looking at a 10-year SBA loan at prime plus 2%. And then we're aiming for a debt service coverage around 1.25. Here we can see that over time, the max loan went from roughly 5.2 in March of 2020. And over time, as the Wall Street Journal Prime increased and as the Fed increased the rate to the right around the max of 8.5, we can see that the borrowing power went down nearly $1 million, right? A loan that someone might have been able to get against the business or leverage against the business for the same cash flow, right? Nothing's changed with this picture. The same cash flow results in the bank being unable to lend that same amount just 3 years later. So borrowing power is a big conversation and a big something that folks need to understand in high interest rate environments when you're having conversations about um, you know, how much can I afford? What's the, we go back to that valuation, right? Like just because your borrowing power is less doesn't necessarily mean that the valuation might not, might be less. And so that's important to think through. Um, but keep in mind, there are definitely solutions for this. And we can show that second graph there, Brandon, just to show a better illustration as well. Um,
Can
so
you
yeah,
see it?
so, yep.
Okay.
So just the visual, again, those same variables, same assumptions, $1 million EBITDA business with a buyer salary of 150K a year, 10-year term loan at prime plus 2%, aiming for a 1.25 debt service. That green line is the max loan that we can lend to, for that same business over time, just in that 3 years, 3 or 4 year span. So it's really interesting to think about, and something that folks should just be aware of and understand what their options are. Um, and I typically tell folks, what are your options when there's that big of a gap, right? You see $1 million gap, it gets a little intimidating. Do I need to come up with that? What does that look like? Usually, I tell folks our options are, we increase the buyer cash injection, right? Like, that's the simple and easiest part, but not everybody can come up with $1 million, right? So maybe we look at a full standby seller note where the seller doesn't get a small portion of the transaction um, over a certain period of time. So there's that option. Um, One that's really shown to be really productive in this high interest rate environment has been only purchasing a portion of the business. So what that looks like with the new SOP changes in the most recent years is buyers can now buy portions of sellers' businesses. So ultimately, what that does is it decreases the price because you're only paying for X amount of the business. So let's just say you're buying 85 or 90%, and the seller holds 15 or 10%. Um, those examples allow for you to decrease that price, that total purchase price, by the amount of which you're not purchasing. Um, so it's an interesting approach, and definitely an option that may be advantageous. Um, Partial changes of ownership, selling or buying portions of the business has its advantages. You keep sellers engaged, right? Sellers are now invested in your growth. If you've got a seller that's not involved in the day to day, but is willing to stay on board as a resource for a certain period of time, longer than 12 months, then maybe buying a portion of the business is the route you decide to take, because that's all what you can afford in today's rate environment. So understanding what your options are really important, so that you're armed and ready for those negotiation conversations with sellers. And then there's the other options, right? There's the options that we don't like to talk about with sellers, which is considering a price adjustment. Maybe just waiting a little while for rates to drop. Um, and then lastly, maybe just coming up with like some form of creative performance-based seller note where the seller doesn't get payments unless certain EBITDA metrics are met. Those last three are usually a tough sell for sellers, right? Because they may want to sell the business right now. They may not. They may feel like their business is appropriately valued, and they have other folks that are willing to pay that much. So, just armed and ready again with what your options are and your quiver is most important for this topic on borrowing power.
Wow. So there were obviously a lot in there, action packed. So let's maybe
Yep.
pull some strings. First off, I think, again, with the new and thank you for diving into the new SBA rule change. I think that's something that is kind of hot off the presses, and people are trying to process what that
Mm,
means, how that might be now introduced into their calculus. And so, we talked about continuing the conversation with office hours. That might be a great topic, which is like,
yeah.
hey, let's just dive into it, ask questions. We can help you understand what this might mean for you, what this might mean for the industry, et cetera, et cetera. So we'll take that one offline.
Yeah.
Um, but I'm also curious, one of the big pushes from a momentum perspective right now is the number of folks that are getting older who own these businesses and basically now need to sell, right? And that's a reason that a lot of folks are interested in kind of stepping into this space. At the same time, when you saw a chart like we just saw where, it's $1 million gap between, just based on interest rates alone, between what people could get from the bank and now, that is a, that is a, a bucket of water kind of thrown on what might be a, a
Mhm.
fire. At a macro level, what do you see as kind of being the impact of these two trends kind of intersecting, which is a lot of interest because folks are now getting older and they're ready to sell, but then also a lot of um, interest rate increase creating pressures on just kind of the amount of bank lending. Is it just deals are happening? Like, to the extent that you can share some thoughts on that, what are you seeing as a broader impact of this?
Yeah, I think folks are certainly still figuring out ways to get creative with deal structures. Like I mentioned, partial changes of ownerships have become more and more popular, right? Because it just gives someone all the more reason to borrow less, get in the business, operate it, and then buy the remaining shares down the road. I think that's a really interesting way and creative way to take over a business because if you do if the seller believes in their business and they believe in you, why not? Right. So, um, and it just gives you an opportunity if you built credibility and rapport with the seller on the front end and they believe you're the right fit for their business. It's just another way for them to take, to have your back, to take ownership in the process moving forward by staying on and showing they also have some skin in the game. Again, yeah, that's one way that folks have been getting really creative with this misalignment, right? Because there's certainly some misalignment. Now, this doesn't cover those sellers that are out there that are selling for potential, right? We talked about that in week one. Buying for potential is still a thing that needs to be discussed, and needs to be, we have to have some clarity and some guardrails behind it. Um, but I think for the most part, finding creative ways to uh, get a deal under LOI um, has still been happening to this day. Um, I can't stress more. We talked about it last week and the week before. Get in the doors, get in business office hours of banks, start making those relationships to try to understand what banks are doing creatively out there because our doors are still open, which means we must be still doing loans, right? So what are we doing that's making us stand out and maybe you can learn some things that um, banks have had success with, have had credit sign-offs on that maybe you can incorporate into your specific deal, and that just helps build credibility with the bank, but also build credibility with the broker and seller.
Yeah. And, I really like what you said there because, you're kind of being humble here, but Live Oak does more of these SBA, excuse me, SBA loans than any other players out there, right? So to say, hey,
Mhm.
look, we might know a little something about it is an understatement. Um, I think the second piece you brought up, and I do want to emphasize this again, this idea of not paying for potential. You went kind of with the angle in our last conversation of don't come in hot, right? The idea is not to come in, hit the ground, and make a bunch of changes, but have a business that's already stable, and then basically protect the ship, and then gradually introduce changes. So I think that's super helpful.
Mhm.
Let's talk a little bit around valuation misalignment. What have you seen? What are some of the pitfalls? Maybe some case studies you can share.
Yeah, misalignment in valuations that often occurs when sellers just overvalue potential, like we've talked about, or when buyers underestimate the cash injection need, right? So um, there might be an example of this is, some folks, I think I mentioned this in our previous meeting, right? But you're looking at a business where your eyes are, glued to the EBITDA number and that's what you're focused in on, but there's a story there, right? So maybe the story is this EBITDA is inclusive of all seller salary being added back, all of the seller's family being added back, but the seller's family, those are roles that need to be backfilled, right? So what does that look like from an EBITDA standpoint? Well, that's less cash flow for your business, right? If you need to hire someone who's going to take the place of a family member who had a crucial role in the business, then that's something to consider, right? So misalignment there because the seller may be thinking, well, any buyer that walks off the street, they can take on these two roles, but maybe in your case, I can't play the role of managing director and accounts payable and payroll, HR, so on and so forth, right? At least not up, off the bat. So understanding what is crucial, the story behind the EBITDA numbers, the valuation that the seller is coming to, um, that is a common pitfall and misalignment when it comes to like not getting on the same page on purchase price. Um, so that's an example. There's so many more examples of this, right? Like there's misalignments that happen on a day-to-day basis. Some more examples of this might look like a seller who had a really good year, right? They we saw this a lot during the COVID years where folks had a really great year and during COVID and the year following, but then started to come back to the business started to normalize, right? And so sellers wanted to sell on the high end without, kind of understanding that they were selling on the high end and that buyers had to be the recipients of the low end, right? And so how does that look from the standpoint of purchase price and valuation and understanding where there can be alignment and protection because we want to make sure our buyer isn't overpaying for potential, like we talked about.
Yeah, and I like that example a lot because, that pandemic, we saw that in the public markets as well, whether it was Zoom or Peloton, it was like an incredible level of performance, but it was very much about that period of time where just all the factors kind of aligned. Um, on that note, from a bank underwriting perspective, you're looking back 3 years, historical, financials?
Yep. Yep. So the bank's looking at 3 years historical financials for that particular reason. We want to look at trends, right? We want to look at the trends of the business. Um, what's normal for the business? Again, I can't stress more. We're looking for disruptions in cash flow, understanding what the story is behind the any disruptions. So, like if going back to that example, when we were looking at 2019, 2020, and 2021, right? A business that was doing 4 million in 2019 jumps up to 7 million in 2020 and then 7.5 in 2021. But then you look at the year to date numbers in 2022 and you see they're well below, the pace that they were in those previous years. They're more in line with their numbers in 2019. There's a story there. We need to understand where we can get most comfortable with and just make sure we're not paying for potential.
Yeah. And on that note, as far as getting comfortable with, what is the best way for buyers to align their deal terms to the bank's expectations?
Yeah. Engage the bank early to review those proposed, valuation documents like we talked about earlier. Sellers are providing buyers with the key documents on how they got to the price that they are wanting to sell the business at. So getting those documents over to the bank sooner rather than later, having conversations with the bank, candid conversations, right, on structure, um, always be transparent on what you expect to take from the business, right? Because that plays a key factor. Looking back at that graph that we talked about, that expectation of the debt service coverage is based on a buyer salary of 150, right? So if you're somebody who knows that your debt to income ratio, like we talked about last week, as a part of the underwriting and due diligence process, is going to be on the higher side, and you might have to go to 175, 200. Be candid about that. Understand, we want to make sure that we get a deal um, in the beginning that's going to be able to get across to the finish line, right? Like the last thing we want is for a renegotiation to happen um, when we're trying to get the closing papers together. So that we see that all happen often. We try to stress that to buyers that engage early, give us the documents, have candid conversations, be transparent. Those are really important aspects to having clear alignment and yeah, clear engagement with the bank.
Now I have a question. This is kind of a follow up, where maybe sometimes a buyer doesn't necessarily like what they're hearing from Live Oak, right? They're like, "Hey, I think this is a good deal." You're saying, "Hey, this is not necessarily making us comfortable." How often do you see buyers committing fully to their relationship with Live Oak in the process because of the trusted partner we're in this together dynamic versus I have a, a slate of folks, and I'm basically going all of them and seeing, kind of playing this game of seeing which one is going to offer me the best terms. Uh, Pros and cons of both, right? Obviously, cons are herding cats, and it's hard to manage processes and kind of build that depth of trust if you're juggling multiple partners. But what do you see, and have you kind of experienced these situations that you would now advise folks that are listening to this call around how to think about this trade-off?
Yeah. Live Oak, we like you said, we've been a crucial player in the game of SBA lending and the acquisition space and expansion space, so on and so forth, right? So in the time that we have been lending in this space, we've certainly figured out what works for the bank and what doesn't, right? We have a slogan here that we do no harm. That's our goal, is to not put a buyer, not put a borrower in a situation where they're unable to pay our loan back. So by taking that approach, that just is going to lead to some hard conversations, right? Like there's some misalignment on, um, those two key data points that we've talked about and I brought up really often: who's our borrower and what potential disruptions are to cash flow are out there. Um, so I feel like if we are going to have that conversation and we want to be candid with each other, that there's going to be conversations where Live Oak doesn't feel comfortable with XYZ, right? And that might be there's too much concentration in this one customer than Live Oak feels comfortable with, right? Because we've seen, and those are typically things that we've seen in the past, right? So we've heard that the past is a great proxy for the future, right? So that's a good way of thinking about some of the conservative measures that we take when we're looking at our credit box. Of if there's some concentration risk that we are uncertain about or cannot get comfortable with, then certainly there might be something that should make our buyers a little bit more questionable. Doesn't necessarily mean that we might not figure out a creative way to get comfortable with that concentration risk. Um, some of that might be just lending less, so taking out less money with the bank. Um, but I think it's just understanding what role the bank has and what our goal is, because our vision and goal is to do no harm, like we talked about.
Yeah, yeah. And I think this is a good segue into, and we've obviously touched on these elements, not just in this conversation, but in our previous conversation as well. The critical components of underwriting. Um, let's let's make this one comprehensive because I think ultimately this is kind of the meat and potatoes of what this conversation is from a bank perspective. Just walk us again, really kind of concretely through what are the elements, the critical components that Live Oak is looking at. And then we'll talk a little bit after that around, again, some of the best practices for making sure these things close, kind of cross the finish line.
Yeah. Yeah, so I'll say in underwriting, our process is usually so timeline wise, it's about 2 weeks. So that's important for a buyer to understand. So once you get a proposal and myself or someone on my team says underwriting takes 2 weeks, now it's game time, right? Like now we're digging into the documents and the due diligence more in depth. We're evaluating buyers' qualifications, cash flow, debt service coverage, and in most cases, getting the engagement with the business valuation company where we're trying to be in lockstep to make sure the value comes at where it needs to come at. All right. So um, I can break that down a little bit further. Like our underwriting process, when we're looking at cash flow, we're doing a deep dive, and debt service. We're doing a deep dive into the global cash flow and debt service and what that looks like. That might be personally what you look like or what you have taken um, to live off of salary wise in the past. So if you're a W-2 employee leaving, your W-2 job, coming over to work in small business where it might look a little different from a salary perspective, it might be a little bit less predictable. Then we just want to understand globally, what have you taken from the business or from companies within your W-2 wages that has helped sustain you and your family and your household, and how that translate to owning a business and being able to pay yourself. So that's one aspect of the global. Um, a second might be if you own businesses out there. So if you're someone who uh, owns passively a business, like a, you know, maybe a laundromat or a transportation business that you're currently not active in, but you have ownership in and you're taking income from, we will look at that. Um, if you have 50% or greater ownership in those businesses, we take time to just dive in and make sure we're understanding how that business is being managed. If you're taking an income from it, will it continue? Understanding what income from a global perspective is available to you, um, in order to cover debt service. Again, those entities won't necessarily have to be a part of our loan, like they won't be a guarantor necessarily, or a borrower. Um, but we just want to make sure during the underwriting process we understand the full picture from a global perspective. So that's one aspect, and then the other would be just looking at the business by itself, right? So how does the business align with debt service? We're looking at the cash flow from the business specifically. That's what we're taking into consideration. Those add backs to cash flow that the broker listed um, on their SIMs, their documents that they supplied to the buyers, and we're coming up with that story of what does cash flow look like, based on all these various, moving parts, seller add backs, um, adjustments that the buyers are going to have. So we talked a little bit about family members from the seller that are playing crucial roles. If their salaries are going to be excluded from cash flow, then we need to add some money back. So we'll make those adjustments within our cash flow metrics there. And ultimately, what we're looking at there is just making sure that we have cash flow for the business and debt service coverage for the business that's being acquired. Um, so really in depth, and then alongside of that is obviously that business valuation that we talked about, the business appraisal that's working lockstep with our underwriting team to make sure that we are aligned with the price and we have cash flow to support it.
God, that's helpful. And one thing I want to double click on because I know this comes up a lot. It's a really big red button issue is working capital. Um, and maybe particularly for people that are doing these deals for the first time, the lack of true understanding of working capital. To the extent that you can maybe share some of your perspective on where folks may get tripped up, best practices around that specific aspect of things, I think that would be helpful because I think that's where things get really gray and a lot of gamesmanship can happen on the behalf of
Hmm.
really
Hmm.
experienced seller and maybe a buyer who's not as familiar, and then ultimately the deal closes and now they're kind of in a bad situation. I would love if maybe you just, maybe share a little bit perspective in terms of what you've seen there, and maybe what you would advise folks around that.
Yeah. Yeah. This goes back to my point earlier that I made about do no harm,
Right.
right? Like we take that approach even when we're structuring deals. So if I'm fully aware that it's, a certain business has relied upon, the sellers maintaining a certain cat level of liquidity, to cover operations, so on and so forth. But as a lender, I'm not going to give my buyer the opportunity to have that cash up front when they start the business. That's harmful, right? Like that sets the buyer up for future failures and just being behind the eight ball if you are um, not able to be able to cover operations and you feel like you're kind of struggling to keep cash in the bank. We want to put our buyers in a situation where they have adequate working capital to cover expenses for at least 30 days at a minimum, right? So we also do what we call we'll run cash conversion cycles where we're looking at balance sheets because balance sheets are really really important to a transaction, right? We want to understand um, what the working capital need of the business is. And by doing so, we run these cash conversion cycle metrics where we're looking at how much the seller has, what's necessary for the seller's business to be efficient, to be operational, to cover a cash cycle as it's building up its payables and its receivables and so on and so forth. Um, so I think that's one of our competitive advantages is that we really take that into consideration to make sure that our buyers are well capitalized when they step foot into the business. so they can focus on the transition, focus on what really matters, and keep the business rolling and stable. Um, Now, a caveat here is this is also an opportunity for negotiations from the buyer's standpoint, right? The buyer can negotiate receivables and inventory to stay with the business, which is a form of working capital, right? It gives you the opportunity to not have to take money out to buy those things, or it's good to know that receivables are coming in the door still. So you've got some accounts that are still needing to be paid, which is cash into the bank. Um, so I think again, getting in the door, having that conversation earlier with the bank to understand what the true need is, and then we can negotiate what working capital is required to stay with the business and see if we can get as much from the seller as we can, and then have the bank cover whatever the seller, isn't willing to leave with the business. So that's a really good approach to making sure the business is capitalized once you step foot in the door.
Got it. That's super informative. Um, okay, so let's touch base on something that we connected on a little bit earlier. You put up a slide, a chart showing interest rates have put us in a situation where basically, it's harder to kind of bridge that gap between where the seller, is thinking they should be, um, you know, paid for their business and kind of what the buyer can do based on the debt available to them. And then ultimately, your answer was you got to be more creative to get deals done. And Live
Mhm.
Oak has been getting busy during this process, so obviously you've been partnering with folks as they've been creative. That being said, one of the key kind of insights from our last conversation was getting too creative can also cause some problems. So
Right.
there's a little
Right.
bit of a tension there. Can you maybe speak to what you consider to be good creative and maybe what you consider to be not so good creative when it comes to trying to get a deal across the finish line?
Yeah. Great question. Yeah, I think good options for when there's misalignment, maybe there's buyer and sellers needing to get strategic on how to meet in the middle. Um, there's some very simple routes, right? Like the first priority would be more cash in the deal, so lowering the leverage, right? So filling that gap with maybe you are looking at an investor to come in, a minority investor that's bringing some cash to the table to help lower that leverage requirement and thus increasing debt service coverage. So that's one simple and easy way of doing it. Again, standby notes are can be really effective, right? Like if you've got a seller note that it makes up a part of the transaction that has a longer um, period of time where there's they're not paying principal and interest payments. um, that then helps your cash flow um, to be more effective, be a little bit higher. um, and then lastly, that purchasing partial ownership of the business is another really key aspect because it lowers that loan amount, thus lowering the amount leveraged against the business. And so it just hand in hand works together to come to help meet in the middle when there's some tough navigations that need to be met.
And what's bad creative? You kind of highlighted what are some things you like to see, what are some things that maybe not so much.
Yeah, we talked about this a little bit on a previous session, but earnouts, adding some aspect of the loan or your LOI where the seller gets more money if the business continues to go the way it is, or if you're able to get comfortable um, with the deal, then that's usually where I say that's the where we want to steer away from, because within the SBA's rules that doesn't meet the defined purchase price rule, where the SBA requires that with any acquisition, there be a defined purchase price. So by rule, earnouts would not apply. So we would have to get a little bit more creative with the way we structure the seller getting a benefit. Um, and usually that comes from a creative seller note where we say we're giving the seller the purchase price that they're looking for, but contingent on the performance of the business, the seller will get X amount year over year based on a metric like EBITDA, right? And so when we think about that approach, EBITDA is going to be something that the buyer and seller agree to and they define so that they're on the same page at how that's going to be calculated in order for a payment to be made. And then the bank's role in that is to just evaluate it, make sure that it doesn't, cross any, cross step or misalign with the bank's documents. Um, what we have in place as far as making sure we're in compliance with the SBA. So those are examples of some creative ways and good creative. Bad creative would be trying to get a little cute on how purchase price will increase later down the line if X, Y, and Z happens, because it just distorts the purchase price as a whole.
Excellent. I think that's really, really solid. I think I would say, insight wise, it's one of the things that, from my perspective, would be one of the key takeaways for folks on this call. Okay, look, ultimately, you know, it is a long, arduous process. And I think that's something else that we hear from a lot of folks who kind of been through it. It's a gauntlet. I remember as a kid, one of my favorite shows was this show called American Gladiators. Kalen, you may be a little bit too young for this one, but
I remember, but
muscle
yes,
bound characters, at every, little, um, you know, part of the whole journey to get there. That's kind of how it feels to acquire a business. And we talked about some of those pitfalls and hurdles that are on the way. What advice would you give to, potential buyers to ensure success from your perspective in the journey?
yeah, prepare early. Um, Align expectations with lenders and crucial stakeholders in the transaction. We talked about the full cast, right? The ancillary cast that we have in on the buyer's side, which it, which would include um, bank counsels. If you're doing a Q of E for your transactions, the quality of earnings, aligning all of these different parties to make sure that you are setting expectations. I talked last week about understanding timelines. So that's part of your preparation, understanding what timelines need to be met. And if you're like me, you set goals, right? You set goals along that process with your lender. By this date, we'll have an LOI signed. By this date, we'll have negotiated this, right? So that's a good way to approach it and set those key foundations, and write it down, right? So you stay focused, have it notated so that all parties are involved and they understand what goals need to be met. Because when that happens, I think you've got everybody moving in one direction, and that one direction is going to be in your favor to help you become a business owner. So, and then obviously just focusing on realistic valuations backed by key documents that are provided by the seller broker, yourself, having those candid conversations with seller and brokers and banker are going to be really important. Um, but it's a collaboration from start to finish, right? So the collaboration is going to be it's going to make or break your experience with the lending process, with the business purchase process. Um, so understanding that and displaying that on the front end and getting it earlier in the process is going to really help. If we've got some guides on that too. So Live Oak wants to be a resource. So we've got guides on buying a business on our website, due diligence items that are involved in that, checklist items. So if you want that those resources, feel free to reach out to Live Oak directly or to Brandon. We're happy
Yeah, we'll get
to
that.
yeah
We'll get that
supply.
on for sure. So we are kind of wrapping up part three of our three-part series. Again, we started with just what are the different funding sources, help people get a better understanding of SBA loans, what are the other options out there, diving a little bit deeper into, what mechanisms exist to fund an acquisition. Then we went into the documentation process with Kalen. What are the timelines to be expected personally and business wise? What are the documents? And, how do you make sure that you're getting ahead of this stuff up front? And then now, obviously, we're talking about, valuing businesses, borrowing power, some of the best practices when it comes to engaging the various stakeholders along the way. And all of these conversations come down to this idea of engaging early with your banking partner. And that's one of the reasons that we were so excited about putting this three-part series together with Live Oak is because there's a lot of knowledge to be learned. And the more you can do up front to prevent pain on the back end, the better. That's kind of why we got this thing going. And so, we're excited to be partnered with Live Oak, and we're excited about making introductions with folks in our network who are ready to take that step to just begin their relationship, right, and kind of start from there. With that being said, Kalen, what are your final thoughts? You're wrapping up this series, this three-part series right now. We cover a lot of ground, not just in this conversation, but across all three. What would be your kind of final parting thoughts to, and Lillian, I know she's also in the background. Feel free to raise your hand as well. But Kalen, what would you leave folks with, as we wrap up this conversation?
Yeah. Well, first I'll say this is an exciting time, right? Like we talk about the amount of folks that are interested in selling their businesses, the amount of sellers that are out there that are willing to sell stable um, and seasoned businesses. And so it's an exciting time to get this space and understand, what opportunities are available outside of the like starting your own business. Um, and so I'd say, certainly like Brandon is emphasizing, making sure that you get in with a bank partner that you trust and work well with, and that you feel like is going to be a great partner for you, is really, really exciting and really important. And so, yeah, exciting times ahead. I think utilizing resources like Gravy and those folks that are out there that are in your corner that are willing to be a resource, willing to be a second set of eyes on transactions, on deals, and so on and so forth, um, is really exciting. I'm excited to see all the key players in this space and to understand that the willingness to join entrepreneurship through its acquisition is growing, and so we need to have appropriate support and foundations. This is what we're here for. So I'm excited about that.
Excellent. And as you know, for folks in the audience, Gravy's all about building these pathways to generational wealth, and delivering kind of insights, access, connections to help push for folks forward through that. And obviously, of our entire network, acquiring a business is the top area of interest. And so we're doing our part to make sure that we're bringing the right folks together, the right information together to help see more of this movement in the space. And so we have a wealth of resources, a few really good guys, again, that Live Oak has provided. We'll make sure we get that out to the network. We're having conversations about scheduling office hours with the Live Oak team as well. Everything from the new SBA rule change around partial ownership to other things. So what I would ask this network for specifically is let us know, what topics you would find to be most beneficial to kind of double click on in these office hour sessions, and we'll make sure that we partner with the right folks to bring those insights to the table. So with that, I brought Lillian up on stage. I don't know if she has any final thoughts as well. I don't want to put her on the spot because she is kind of laying back right now. But I did want to say again, appreciate the partnership with Live Oak Bank. Excited about 2025 and what we'll see as far as this network specifically mobilizing and moving forward and buying a business. And we will continue our partnership with more one-on-one and small group sessions as folks have more specific issues and problems that they want to help address. So with that being said, want to say thanks, Kalen. Appreciate you joining us as we wrap up here. Lillian, thank you for your support and what Live Oak is doing in the space, particularly in the inclusive banking space as well. So with that, we will end the session. Thank you everyone for joining. Again, reach out if there's anything else you want to do from a follow-up perspective or connections you want to make to Live Oak team. We're happy to do that. Otherwise, have a great rest of your day. We'll be in touch soon. Take care, everyone.